Welcome back. Some of the most common questions aspiring stock landlords ask us are: number one, why would someone want to rent my stock? Number two, how hard is it to find renters? And number three, why do people want to rent from me at 25%, 50%, even 75% of my original stock purchase price? Well, in this lesson, I'm going to attempt to answer these questions and more. Let's start with question number one. Why would someone want to rent my stock? Why would anyone in their right mind want to rent my stock? What's in it for them? Why wouldn't they just buy the stock themselves? The answer is actually pretty simple and logical. Let's say two investors both have $1,000 to invest in the stock market. Investor A uses all $1,000 of his investable cash to buy 100 shares of XYZ stock for $10 per share. Investor B, however, wants to spread her investable cash further. Rather than buying actual shares of company XYZ's stock, Investor B decides to buy the option to buy the shares at a strike price of $15 per share sometime next year. In our hypothetical example, Investor B is willing to pay Investor A $2 per share for the option to pay Investor A $15 per share later, if the stock price rises above $15. By doing so, Investor B still has $800 left over in cash to invest in other stocks. That is, Investor B hasn't put all of her eggs in one basket, so to speak. Her initial investment and risk concentration levels are low. She's only spent $200 so far and still has $800 in cash left over to buy call options in other stocks, thereby diversifying her portfolio. It's like betting on several different numbers on a roulette table. Alternatively, in the event company XYZ's stock doesn't rise to the $15 strike price, plus 1 penny, before the option expiration date, she can try repeating her original strategy and buy another call option for the same stock. In fact, she can repeat this 5 times. 5 times $200 equals $1,000. In this case, she wouldn't be diversifying her portfolio, but she would be diversifying her time horizon, so to speak. That is, instead of using her leftover $800 to buy call options on other stocks, she could spend the $200 4 more times on call options for the same stock. In effect, resetting the expiration period deadline each time. It's like playing another spin at the roulette table after you've lost on a previous spin. Of course, in our renter's case, she has to pay to play each and every time. In addition to a low initial investment and low risk concentration, Investor B also benefits from a theoretically unlimited return potential. That is, if company XYZ stock is the next Google and skyrockets to $900 per share, she stands to earn $88,300 in profit by only risking $200. Meanwhile, Investor A, having actually purchased the stock for a total of $1,000, is willing to rent, that is, write a $15 covered call to Investor B in exchange for $2 per share or $200 in cash. As you can see, Investor A's ending cash reflects this $200 rental income. Unlike Investor B, Investor A's initial investment and risk concentration levels are high. He spent all of his original $1,000 on one single stock. In addition, Investor A's profit is limited. The most he can hope to earn during this rental expiration period is limited to $7 per share. That is $2 rental income plus $5 in stock appreciation. And that's if the stock exceeds the $15 strike price. Are you starting to see why people might want to rent your stock? It seems as if our renters are getting the better end of the bargain. After all, Investor B isn't risking as much money. She has money left over to buy the call options of other companies, and her potential profit is unlimited. That's why people want to rent our stocks. Meanwhile, stock landlords like us seem to be putting all of our eggs in one basket. It's as if we placed one single bet with all of our money all at one time on only one number on the roulette table. But things are not as they seem. There are 2 very important advantages that swing the balance of power over to stock landlords like me and you. One is the time decay advantage, and the other is the break-even advantage. Time is a stock landlord's friend, while it's the enemy of those that rent from us. An option's expiration deadline is like a spinning roulette wheel coming to a slow stop. Investor B only has until the expiration date to win. Investor A, on the other hand, can leave his single, highly concentrated bet on the table for as many spins as he likes. He can just keep on spinning without ever having to place additional bets. This is the fundamental difference between being a stock landlord and someone that rents out our stocks. To better understand this concept, let's look at a few examples. This chart assumes investor A bought shares at $10 per share and wrote a covered call. That is, sold the rights to buy the shares at $15 1 year from now to another investor if the shares reach $15.01 on or before the expiration date 1 year from now. Right now, with a whole year to go, the person renting investor A's shares is optimistic. After all, she has a whole year for the stock to reach the $15 strike price. But, as we've stated previously, time is not on her side. Let's say that 6 months goes by and the stock hasn't risen much. Now our renter starts to get a little nervous. If she tries to sell her $2 call option now, at the 6-month mark, to yet another renter, she probably won't recoup her $2. That's because the stock price hasn't risen much or at all. And now the expiration date is only 6 months away. The point is that our renter's optimism, and hence her willingness to pay a rental premium, fades with each passing day, assuming, of course, the underlying stock price isn't rising. With each passing day, the chances are getting slimmer that the stock will make it to the $15 strike price. Now, imagine there is 1 day left before the expiration date, and the stock is still trading at $10 per share. Why would anyone be willing to pay a $15 strike price call option that expires tomorrow? They wouldn't. Anyone can just wait until tomorrow and probably buy the stock for $10. The $15 strike price call option would therefore expire worthless. Great for us as a stock landlord, terrible for our renters. Her $2 bet is over. That said, she can place another bet and try again. Investor A, however, gets to leave his bet on the table and spin again for free. That is, he is now free to write another covered call and collect even more rent. Let's look at a similar example. Again, this chart assumes investor A bought shares at $10 per share and sold the 1 year $15 strike price covered calls for $2 per share. Now, however, let's imagine the shares do rise to meet the $15 strike price at the expiration deadline. How much is the $2 call worth at expiration? 0. Why? Because the stock must beat the strike price by 1 penny in order for the shares to be automatically taken from us at the $15 strike price. Again, who would want to enter into an agreement 1 day before the expiration deadline and pay $2 for the right to buy the shares tomorrow at the $15 strike price if anybody can just wait 1 day and buy the shares for only $15? Here again, investor A gets to keep his shares, now worth $15, and he still has $2 in rental income. Now, if investor A rents his shares out again at the $15 strike price, he will probably earn much, much more than $2 in additional rental income because the stock price has risen 50% since he originally bought it. Of course, he could just as easily sell the shares for $15 and pocket the $5 in gains. Our renter, however, is out of luck again. She can opt to place another bet and spin again, or she can find another stock to gamble on. Here's one last example. This chart also assumes investor A bought shares at $10 per share and sold the 1 year $15 strike price covered calls for $2 per share. Unlike the other examples, however, here we pretend the shares fell to $9 before the expiration deadline. How much is the $2 call worth at expiration? 0. Why? Well, by now you know the answer. Why would anyone pay $2, $1, or even 1 penny for the right to pay $15 for a stock they can buy for only $9? In fact, the only time the covered call could be worth anything more than 0 at the time of expiration is if a $15 strike price were exceeded. For example, if the stock were trading at $15.01 1 day before the expiration date, then the $15 strike price would be worth approximately 1 penny. If the stock were trading at $16 1 day before the expiration date, then the $15 strike price would be worth approximately $1. If the stock were trading at $19 one day before the expiration date, then the $15 strike price would be worth approximately $4. Hopefully, you now understand what a powerful ally time represents for stock landlords like me and you. The previous examples also underscore the other tremendous advantage stock landlords have, namely that stock landlords possess a significantly lower and thus safer break-even point, the stock price that determines whether or not we are making a profit or losing money on our investment. As you can see from the chart, Investor A's break-even is now $8 per share. That is his original $10 investment minus $2 in rental income. Investor B's break-even is now $17. That is, the stock must reach $15 per share. Plus, she must also earn back her rental payment of $2 in order for her to start making any money. Now ask yourself, what are the chances that the stock will rise 70% from $10 to $17 per share prior to the expiration period deadline? I suppose it could happen, but I wouldn't bet on it. Now, ask yourself, what are the chances that the stock moves up or down by 20% over the next year? Well, relatively speaking, the odds of that happening are much better. It's a safer bet, and that's why we're rent collectors and not rent payers. This chart sums up the key pros and cons of buying, or in our case, selling, call options. The left-hand side of the dotted black line answers the question of why people want to rent our stocks, while the right-hand side of the dotted black line illustrates why we prefer to be stock landlords. Okay, now on to question number 2. How hard is it to find renters? Unlike real estate landlords that must seek out responsible tenants that are willing and able to pay them and that won't back out of their lease agreements, stock landlords never worry about finding qualified investors willing to rent their stocks. And stock landlords never worry about renters backing out of their contracts. Why? Well, before I answer the question, I think it would be very useful to provide you with a little history about how the options market started. For that, we have to go back in time, all the way back to the early 17th century in Holland, where tulips were far more expensive than gold. At the peak of tulip mania, a single prized Semper Augustus tulip bulb, with its blood-red flares and flames, could command 10,000 Dutch guilders, an exorbitant amount that could have purchased a grand house on the most fashionable canal in Amsterdam. To hedge risk in case of a bad harvest, tulip wholesalers began to buy call options, and tulip growers began to buy put options. We will discuss put options in my video series entitled Buying Stocks for Half Price. But for now, just know that calls and puts form the basis of the entire equity options marketplace. As the price of tulip bulbs continued to rapidly rise, the price of the call options began to skyrocket as well. When the tulip bubble finally burst, many people were unable or unwilling to fulfill their options contracts. The Dutch government tried to force investors to make good on their options contracts, but it was impossible. The important takeaway here is that the idea of call options is not a new idea. It's a very old concept. But back then, it was unregulated. Jump forward nearly 200 years to 1791. That's the year that the New York Stock Exchange first opened. Not long after, investors started trading options. The problem was that back then, a centralized marketplace for options didn't exist. Each underlying stock strike price, expiration date, and cost had to be individually negotiated. As you can imagine, it was a slow, cumbersome process. In short, it was very hard to rent your stock. Only a handful of stocks were allowed to be rented, and even if you owned one of the approved stocks, you had to search high and low for someone to rent it from you. By the late 1800s, broker-dealers began placing advertisements in financial journals on the part of potential options buyers and sellers, in the hopes of attracting another interested party. It wasn't long after that the formation of the Put and Call Brokers and Dealers Association helped to establish networks that matched options buyers and sellers more efficiently. The 1929 stock market crash made people realize that Wall Street needed better oversight. Subsequently, Congress passed the Securities and Exchange Act of 1934 and created the Securities and Exchange Commission, the SEC, to better protect investors. Options trading started to become mainstream in 1968 with the advent of the Chicago Board Options Exchange, the CBOE, or CBOE for short. And just as broker-dealers helped the options market nearly 80 years before, market makers started providing liquidity in options trading by risking their own capital for personal trading. Today, market makers are the backbone of the CBOE's trading system. They take the opposite side of public orders by competing in an open outcry auction market. To avoid the fate that the Dutch options traders faced nearly 350 years before, the Options Clearing Corporation, the OCC, was formed in 1973 to ensure that the obligations associated with options contracts were and are fulfilled in a timely and reliable manner. By the summer of 1974, the average daily volume on the Chicago Board Options Exchange reached 20,000 contracts per day. Recall that one contract is equal to 100 shares, so 20,000 contracts is the equivalent of 2 million shares. But it wasn't until the advent of online trading via the internet in the early 1990s that a person could put down their landline phone, stop dialing expensive brokers, and stop praying that someone would be willing to buy or sell their options. The internet quickly changed stock trading forever, making it super efficient and very easy to find buyers and sellers. By the mid-1990s, more than 20% of Americans were investing in stocks, compared with less than 5% the decade before. Today, the U.S. options market is one of the largest, most liquid, and fastest growing markets in the world, with 7 U.S. options exchanges, including the Chicago Board Options Exchange, the CBOE, all regulated by the SEC, with all options transactions clearing through a single independent clearinghouse, the Options Clearing Corporation, the OCC we mentioned earlier. With more than 3,300 listed equity and index-based options and over 4 billion contracts traded each year, finding renters has never been easier or safer. But what about my stock? How hard is it to find willing renters for my stock? First, before you buy a stock, you should check to see if it's one of the more than 3,300 stocks that actually offers option trading. Assuming you own stocks that do offer options trading, you need to know how liquid those options are. A liquid market is one with ready, active buyers and sellers at all times. One of the top mistakes options traders make is that they attempt to trade illiquid options. That is, options that don't have a lot of buyers or sellers. So how do we measure option liquidity? The best way is to look at 2 factors: the daily volume and the open interest. The daily volume of a specific options contract is simply a measure of the number of times that contract was traded on a particular day. For example, options of Bank of America are very liquid. As you can see, today's volume for Bank of America's January 17th, 2015 $15 call option is 1,989 contracts. This means that 1,989 contracts representing 198,900 shares have been traded today. The higher this daily volume, the more liquid the options are said to be. Contrast this with Corcept, ticker symbol CORT, a small biotech with illiquid options. As you can see, today's volume for Cort's February 22nd, 2014 $2 call option was only 20 options contracts. That represents only 2,000 shares. What if you had wanted to sell to open 50 Cort call option contracts today? You most likely would not have been able to do it, at least not without drastically lowering your asking price. One note about volume. As with any investment, if prices jump up or dive down, but the volume is relatively low, then the price change might be artificial. That is, it's probably not a solid indication of a price trend. If, however, the price jumps up or dives down and the volume is unusually high, then the price is probably going to continue trending in the same direction a little while longer. While daily volume can help us, it can only tell us so much. We also need to know the open interest in order to truly determine how liquid our options might be. Open interest indicates the total number of options contracts that are currently open. In other words, contracts that have been opened but not yet closed. Options contracts can be closed through any one of the following actions. Number one, a stock landlord decides to buy to close a position. Number two, our renter or someone the renter resold our contract to decides to sell to close his or her position. Number three, our renter or someone the renter resold our contract to decides to exercise his or her right to buy our shares at the strike price, thus closing the position. Or number four, shares are automatically assigned to our renter because the share price is higher than the strike price by at least 1 penny. This too closes the position. Let's take a look at a few examples. The open interest for Bank of America's January 17th, 2015 $15 call option is 261,058 contracts. This means that 261,058 contracts representing 26,105,800 shares are currently open. The higher the open interest, the more liquid this option contract becomes. Let's contrast Bank of America's large open interest with that of Court's. Here we can see Court has an open interest of a mere 82 options contracts, the equivalent of 8,200 shares of Court. Such limited open interest will most likely force landlords like us to drastically reduce our rental asking price just in order to rent out all of our shares. Obviously, that is a situation we, as smart investors, want to steer clear of. Therefore, avoid options that have either low volume or low open interest. How do we calculate open interest? Well, it's not as simple as you might think. Recall from the previous lesson that when we rent our stock, we must sell to open. When we sell to open, we are creating a new position. But the impact on open interest is not yet clear. First, we need to know how our buyer is handling the transaction. For example, our renter could be buying to open. In this case, both of us are opening a position, so open interest would increase. Alternatively, if we or another landlord are buying to close a previous sell to open position, then the sell to open and buy to close would cancel each other out and have zero impact on the overall open interest. Trying to calculate open interest is difficult. In fact, it's impossible unless you have access to every options trade for that stock. You would have to know how the trades are being handled. That is, whether or not people are buying to open, buying to close, selling to open, or selling to close. That's why the OCC calculates it for us. They clear every trade and then use the following table to determine the impact on open interest. Now, for the final question, question number 3. Why would someone pay 25%, 50%, even 75% of the stock price just to rent it from me? I'm going to use an example to demonstrate how this happens. Let's say Affimax's stock, ticker symbol AFFY, just plummeted from $15 all the way down to $2.50 per share following a failed phase 3 trial of some experimental drug they were working on. Let's also assume we think the stock is oversold and might rebound. Therefore, we purchase the stock at $2.50 per share and hold on to it. That is, we don't immediately rent it. A few weeks later, the panic is over and investors slowly start buying Affimax stock again. Subsequently, its share price rises to $3 in just a few weeks. Now, investors are starting to feel optimistic about Affimax again and think that perhaps in a year or two, the stock could be trading at $7 or $8 again. That would still represent a 50% drop from its former $15 share price, but not bad for those of us that bought the stock at $2.50. We'd be happy with the $7 or $8 share price. You, however, aren't so sure. With the stock currently trading at $3 per share, you decide to play it safe and sell the $3 strike price covered call for $2 in rent. What a deal! You just agreed to sell a stock you bought for $2.50 for $3 in exchange for $2 in rent. The rental income alone recoups 80% of your original stock purchase price. And because you sold a covered call at the money, That is, you set the strike price at $3 when the stock was trading at $3. The normal IRS rules apply. Had you sold the $2 strike price covered call when the stock was trading at $3 per share, then you would have written a covered call that was in the money, and the IRS has special rules for in-the-money calls. Lastly, if we had sold the $4 covered call strike price when the stock was trading at $3 per share, the call option would be said to have been sold out of the money. That's great for us, not so great for our renter. Recall that 75% of the time, options expire worthless. The reason for this is simple. Our renters prefer to buy out of the money calls because they're relatively inexpensive. Their frugality is their undoing. The higher the strike price, the less landlords can charge in rent, but the less likely the higher strike price will ever be attained. It's one of the most common mistakes prospective renters make. Well, we've come to the end of another lesson. Please take a moment to test your knowledge by taking the following quiz. Thank you for watching.